Hi, everybody. Welcome to today's webinar on the car rental marketplace in July of 2020. I'm Jason Manelli. It's nice to be speaking with everybody out there today. I'm joined by Michael Delorenzo.
Hello, everyone. That's me.
So Mike and I will be your panelists on today's webinar. We also have John Dill, who is on the line as an organizer. John, why don't you say hello?
Hey, everybody. Thanks for joining us today.
So John, we'll be taking your questions. So in the meeting controls, you should see that you have chat and questions and polls. So if you have any questions during this webinar, anything that we cover, please feel free to submit those to us. And John will be going through and answering those. And also, if you'd like to ask the question of myself or of Mike, we can actually make you a live participant in this webinar and give you the ability to ask us the question and have a conversation with us. And that's really our aim. We're hoping that after we move through the presentation, we'll get some good feedback from the audience and be able to take some Q&A. So it's not just the two of us doing all the talking. But also, just as sort of a housekeeping note, if you're not familiar with the GoToWebinar controls, you should be seeing Mike and myself right now. Very shortly, I'll be sharing my screen, so you should be seeing that now as well, the presentation in the background. So once we start speaking, we'll minimize our webcams, but you are in control as a participant in terms of your view and minimizing certain elements of it. So all of those controls should appear along the top of your screen in the same bar that you see the feed from the cameras coming into now. So
also, just to let everybody know, if you've got to leave because something happens and you can't stay online for the whole session, don't worry, it's being recorded, and we will send out the recorded session as well as the presentation to all the people that registered. So if you got to dip early, don't worry about it.
All right, well, without further ado, I'm going to get into the presentation now. So, and we've titled it the Car Rental Market Update July 2020, Spring Slowdown Begets Summer Surge. So really what this is an answer to the eternal question that we've been asked many, many times over the last several months by concerned family and friends and colleagues. How's business? So we're trying to attempt to answer that. So just a little bit about us. So many of you might probably know Mike Delorenzo, but Mike has been a veteran of the car rental industry for over 50 years. He was a budget franchisee before becoming involved with MP Auto Group, is now the president of MP Auto Group, which is the franchisor and parent company of the NextCar and Priceless car rental brands. Those brands are made up of franchise, corporate, and affiliated locations with over 175 car rental locations. My name is Jason Manelli. I'm a proud veteran of this crazy industry for 20 years. I'm the president of Rent-A-Wreck of America. We have over 125 locations in the US and overseas. So Mike and I are colleagues, and we work together under the auspices of our shared ownership, but we are completely separate companies. So as a matter of disclosure, Mike can speak more definitively for the MP franchise group companies, NextCar and Priceless, and I am representing more of the Rent-A-Wreck side of the business. To give just a little bit more background about who we are, for those of you who are not familiar, so NextCar is a company that was founded in 2003. It's grown to have 32 locations. 16 of them are corporately owned and operated here in Maryland. We've also recently expanded to have airport locations and far-flung locations like Auckland, New Zealand, as well as our home base here, BWI Airport, Puerto Rico, St. Martin, the island of the Caribbean, Fort Lauderdale, Miami, Orlando, many of the sunshine spots. So we've definitely, NextCar seen the impact of the pandemic and COVID, not only here in our local market, but down in those travel destinations and those sunshine states and Caribbean markets that we're a part of. But here on this page, you're just seeing some snippets and shots of NextCar locations around the country. Priceless, founded in 1998. We have 55 Priceless locations currently operating, 38 in the US, 17 overseas. We're in locations from Bucharest, Romania to Mexico, and also Lauderdale, LAX, Miami, Vancouver, and Tallahassee, and other points in the US as well. So again, just some shots there of some of our Priceless locations around the country. And finally, Rent-A-Wreck. We've been in business since 1968 and franchising since 73. We've got 124 franchise locations, 1 corporate-owned store here in Baltimore, 84 in the US, 40 outside of the US, serving markets and airports in Bergen, Norway, Billings, Montana, Chicago, Illinois, Newark, New Jersey, Oslo, St. Martin, Reno, and SeaTac, Seattle, Washington. So we've got a diverse group of locations here between NextCar, Priceless, and Rent-A-Wreck, different demographics, different customer sets there, different regions and geographical locations, local market versus airport. So this is the data set. This is the kind of our car rental universe that we're going to cover in our presentation today. And I'm hoping everybody's able to see my screen clearly. I'm going to be running through a series of slides and analyzing data because, I really believe that one of the things that sets us apart as an organization is our adherence to a strict analytical model where we measure and analyze all of our data very closely. And so what you're seeing are screens out of our proprietary NP tools system that our corporate stores and franchisees are able to access. So we've built business analytic tools into those platforms. So that's what we're presenting here. And the data set that we're looking at now are for those NextCar corporate stores in Maryland, including BWI Airport. So we're not showing any of our franchisees data, not showing any of our affiliates data. Don't want to have any kind of privacy issues there. So this is all corporate stores, but that's how we're able to have access to the granularity of reporting that we have here. So first slide that I'm showing you is a look at 2019 compared to 2020, the first period of the year, January through March, the pre-pandemic here in the US. We were hearing the rumors of COVID. We were all watching the news, but we really weren't seeing it impacting our business. So you can see in the two charts, the one on the top is for 2019. You can see our revenue for those 16 corporate stores was sitting at about 2.88 million for January, February. Dropped down to 2020, you see it moved up to 2.89 million. So mainly flat, up a little bit. You can see the rental agreements, that's total rental agreements is the first number there. A little bit of a reduction year over year, but T&M was more. So, different business conditions. Mike, did you have anything you wanted to add to this first slide?
Well, it's obvious that the average daily rate went up, 40 cents, and the average rental went up from 168 to 179. So obviously the length of rental went up during these two periods. By the way, January and February here in Maryland was a very mild winter. I don't remember now, but I don't think we ever saw a snowflake that didn't melt within 20 minutes.
I had forgotten that, Mike. That was the story before before COVID hit, was how mild of a winter we had. Well, moving along then, the next slide I'm going to show again out of that proprietary MP tools and an analytics system that we have is a breakdown of the sources of our business. So in that first part of the first two months of 2019 compared to 2020, you can see last year our company-owned channels made up 82% of our bookings. GDS channels made up 17% of our bookings. A large chunk of those were government travelers, 4%. Expedia was also about 4% of our bookings, Priceline about 4%, with some of the other sources mixed in. And in 2020, we were actually seeing a reduction in company-owned channel bookings, or an increasing share, I should say, in GDS bookings. So Expedia had grown their bookings with us. Priceline had also grown their bookings. Really across the board, all the GDS channels were up in early 2020. And when we look at which of these 16 NextCar locations were receiving what share of business, 2019 compared to 2020 in those first 2 months, we could see that our airport store, BWI, in 2019 was 22% of the volume, and that in 2020 it had increased itself to be 29% of the volume. So our second largest store here, it's got the code NGA. That's a dealership-based store that does a tremendous service loaner volume. So it was a large slice of the pie as well. And you could see that because of different warranties and different recalls that were accounting for that business in 2019 and 2020, that had gone away, and there were other stores that had taken its place in the local market as the larger share of the business. But overall, the airport was growing, and you could see that the GDS channels from the previous slide were fueling a lot of that growth, and this is pre-COVID. So March was the month where everything changed. So in the month of March here in the United States, for our stores, for our NextCar corporate stores in 2019, you could see it's such a big difference that the chart has a different scale. So in 2019, it goes from 150 to 100 to 50. And in 2020, you're at 80 at your top. So, there was never a day in 2020 that peaked as high as we peaked in 2019. And there were many more days where we were far lower than we ever got in 2019 in the month of March. And it made for a 33%, sorry about that, we go right back to that, 33% reduction in total time and mileage in the month of March, comparing 2019 to 2020. You can also see a precipitous dip in the number of rental agreements we wrote as a company, 7,700 in 2019 compared to 4,360 in 2020.
So here in Maryland, Jason, just to break away for a second. So here in Maryland, what happened is March began, the first 2 weeks of March was normal business. And then sometime around mid-March, 15th, 16th, 17th in there, they started the shutdown process. So we went from a normal business process the first few days of the month to an absolute dead business process the last few days of the month. So it was a blended results here. So what really happened, you'll see in the next slide, is the first 2 weeks were normal, and the second 2 weeks were complete shutdown. And I didn't know if you had anything else to add to this slide, Jason.
Well, I just would like to expand to look again at where the business was coming from and how that changed as how that changed year over year. So we began to see the tilt. GDS reservations were a growing source of our business the first 2 months of 2020. In 2019, you can see that it was 22% of the reservation traffic in the month of March, but then suddenly in 2020, that drops to 17%. And our company-owned channels are accounting for 78% of the bookings in 19, but suddenly that proportionality swings over to the company-owned side. And we're starting to see the government business, which here in the Baltimore Washington area, we have quite a bit of government travelers through the DTMO service. And then again, here we are in the month of March, year over year, 19 over 20, the location share. So BWI is again showing a diminished location share. So that was March, and then we got to April, May, and this is really when things got ugly. So when you look at April, May for these 16 locations, including BWI Airport, again, the scale of the chart tells a lot of the story, because Last year, we needed a $200,000. We had days when we were approaching $200,000 in revenue. This year, we didn't have a single day where we broke anything over 80,000. And that, was really only at the very end for Memorial Day weekend. We finally started to see some of the business coming back. But, 60% is a huge drop, obviously. I mean, it's, $4.25 million in revenue in those 2 months in 19 to 1.4 in 2020. Book rental agreements issued 17,345 to 3,963. And look at this number. So how many reservations were we carrying forward in these months? We had 10,798 booked in our pocket to pick up in the future in April, May of 2019. 1975 in April, May of 2020. So the customers weren't booking for future pickups either. Everything was slowing down. So the business had cratered at that point. Luckily, we didn't see it go any further than this. Mike, anything else you wanted to add on this slide?
Well, you could see again that the length of rent went up. The average contract was $253.10 in 2020, and it was $193 in 2019. The daily rate went down. 2019, it was $35, and in 2020, it was $31. So it's obvious again that the contracts that did stay were out for a much longer time. So that was very interesting, something that I wouldn't have predicted. Go ahead, Jason.
Okay, and just continuing, thank you, Mike, along with our source of business analysis. So in the bottom of the bottom months here in April and May, comparing what it was last year to what it was this year in terms of sources of business, you can see last year, we were picking up 22% of our reservations from the outside, OTAs, from the government, from Sabre, from Expedia, 7%, Priceline, 6%. We had a nice blend of different sources of business. Our contact center, that's our traditional call center, 9% of the bookings. Counter bookings were 11%, walk-ins 37%, our own website, prepaid, pay later, accounting for another 16 to 18%. As you switch over to 2020, you see all of that GDS business just going away from having a 22% share of our business to having a 5% share and accounting for only 2% of the revenue. The government, completely ghosting us, completely shutting down. The travel agents, the Expedia going from, a 7% to 1.6%, Priceline down to 2%. So it was really our own call center, which was able to grow its share of its bookings with us. Our counters, our people again at our stores, walk-ins grew to be 51% of our business, counter booked. So somebody literally booking with the agent at the counter for a future pickup. And then our own website, saw a reduction significantly in prepaid as customers lost confidence. So, we think that if people have more confidence that they're definitely going to take the trip, then they'll prepay and take the different discount. But if they don't, if they have a little planted seed of doubt in their mind about whether they're actually going to go, they tend to book pay later and not take the discount. So we saw our share and the way that business distributes change during COVID. So it was a sea change, obviously. The amount of business was reduced by 66%. Where the business was coming from really contracted to our own channels, our own stores. The real estate was what was getting people to come in the door at that point. Where they were renting changed. So last year BWI is that huge. The airport store was the biggest chunk of the pie, and then during the COVID months, now you can see that it drops to being 11%. So no longer the biggest during those COVID, and some of our local market stores that were at dealerships were eclipsing the BWI store in terms of volume, and then in terms of revenue, BWI was down to under 5% of the total revenue for the company. And there were, a number of local market stores in downtown Baltimore and Prince George's County and the DC suburbs that's all have more revenue, which would be, unheard of in the 5 or so years we've had a slot at the consolidated facility. It's always been the largest volume store. It's 24/7, and so just shows the complete change in the way that folks were traveling and not going to airports. So, Mike, anything more to add on that before we move out of April?
No, I have stuff to add when we get to June. So
great.
Go ahead.
All right. So here we are in June, and I'm glad. I'm just as glad as Mike is to turn that page of the calendar. So, in June we began to see things really pick up for us, and it's encouraging to see that once again the scale of these two charts is the same. So, behind the scenes, we're starting to get into the same level of bookings that we had last year. We weren't able to go from a 66% whole all the way back to normal overnight, but to be able to climb out of that to being only down 28% as of July 12th was a pretty remarkable thing to watch. And you can see then the reservations are starting to build up now. The rental agreements came up to 7,300, and the revenue for this group of stores in that 5 to 6 week period of time, where it was 3.18 million last year, it's 2.2 million this year. So, and Mike, anything to add on this?
Yeah, I do. I have quite a bit to add here. So what's hidden inside the numbers that you can't see here is the differences in the socioeconomic climate. So our stores are distributed through the wealthiest, probably the second wealthiest county in the United States, through average income areas and then to low income areas. And what's hidden inside these numbers is that we were on lockdown here in Maryland until the end of May. We came out of lockdown like the weekend before Memorial Day weekend, and the public really didn't come out of the house until Memorial Day weekend. And it finally started showing up at our rental stores in June, that business started to turn around in June. But what's hidden inside of these numbers is that the lower income, less educated areas started outperforming the higher income, better educated areas dramatically in June. It's hidden in these numbers. So the lower income areas, their sales were only down 10% to up as high as 20% in June over same time last year. And in the higher income, better educated areas, the sales stayed in the 60 to 40% reduction range, a little bit dependent on store. So it was a very interesting dynamic that was playing out in June that caught me by surprise.
Yeah, just to back that point up, Mike, you can see that your North Avenue store, which is in a very, an urban downtown Baltimore area in 2020 compared to 2019, was 3% of your volume, 5% of your revenue. In 2019, it goes to 6.6% of your volume and 11.5% of your revenue in 2020. So, that definitely shows that.
Yep. Yeah, there it is right there. So that was an interesting observation that jumped off the page when I started studying the numbers for June.
And I just wanted to show the rebounding of the GDS channels here in this June to July 12th period. So we saw the previous set of data looking at April, May was at 5%. So it comes all the way up to almost 15%. So we've got a tripling of that business. And also you can see our prepaid is growing. So it's now back to being the dominant form of booking on our own website after it was being outbooked 2-to-1 by pay on arrival in the 2 months before. So I think that's sort of a thumb in the air kind of way to look at traveling customers' confidence, is to look at how much they're willing to prepay. And in fact, you could see prepay was about the same ratio as 2019 for that same period of time. So, and again, on the locations, BWI was 30% of the volume in 2019. They weren't able to claw back all the way to where they were, but they're way better than they were in the previous look, where they were accounting for less than 12% of the volume and less than 10% of the revenue. They're now over almost 18% of the volume and 13% of the revenue. So, and Mike, I know that you've got some data that I didn't have access to when I was preparing this about BWI. So why don't you share how that business is shaping up at in July?
Yeah, again, I'm not sure what's driving the numbers. I wish I was more clairvoyant, but as we get into the first 2 weeks of July, which we do a weekly forecast here, and so I have numbers that are through the 13th of July, and BWI is only showing down 25% from July of last year, which was the best month ever in the history that we've had that operation there. So that's quite interesting that it's back to 25% down. I can't imagine being happy to say I'm only 25% down.
But when you've been 66% down. So down but looking up, I think, is the mood.
Oh, how poetic you are, Mr. Manelli.
Just continuing along, this last slide gives you a look year over year from the very first day of 2019 to from the very first day of January to July 10th, 2019 over 2020. So, one thing that jumps out at me is, yes, the revenue is down 35% year over year, but our rental agreements are down way more than 35%. It's really closer to 50%. So what Mike has been pointing out throughout this conversation about rate and average rental amount is true on a macro level. We're getting better rate. We never went low in terms of cutting rate to get market share. So, in combination with some fleet reduction strategy, I know we've done in behind the scenes here, some of these numbers aren't as bad as they might look, right, Mike?
No, in fact, I'm not sure why it doesn't show up on your slides here, Jason, but in June, we actually had a $5 a day improvement in our daily dollar average, and it does not show on your slides. So I was very encouraged about that, that we're able to get more rate across the board, just like all the other vendors in every other business. Everybody has to have noticed that the price of everything is going up.
I think that one of the reasons it doesn't show in the average daily is that length of rent that you brought up, Mike. The average rental ticket is much higher year over year.
Yeah, but it still show up. We have to check to make sure that the software has the correct calculations in there.
Fair enough. So, but moving along, we have been able to lower costs by taking fleet away. One of the things the airlines and the hotels and some of the other folks that are involved in travel verticals don't have that flexibility, but we were able to sell into what was a pretty hot used car market. We're also able to remove insurance from vehicles and save some fixed cost on the vehicles that we did, quote unquote, park during that period of time when they weren't rented. And obviously we were able to take advantage of things like PPP to help with our payroll during that period of time. So there's mitigating factors that really do make this a much brighter picture than it could have been, looking at what we were dealing with in April and May. So the fact that we're talking about narrowing our gap now and forecasting within 20% of our best month ever last year at our airport store shows how far we've come. So again, the year over year look now at that NextCar business and source of businesses, just showing that, we did increase our share of company-owned channel bookings and reduce the share of outside source bookings year over year. And that is driven by the change in travel behavior, and again, the overall impact of reducing that big airport store that was over 25% of our total business last year to now being closer to 1/5 of our business. So as we move along, so that was the NextCar stores, and I just wanted to pause. John, do we have any questions from the group that we wanted to take now, or should we continue along with the presentation?
Continue along with the presentation.
Okay, so from a level of looking at 16 different stores combined here with the NextCar group, including an airport, now we go down to a very granular look at just our Rent-A-Wreck corporate store. Again, Rent-A-Wreck is a completely separate company. We are a customer of the MP Auto Group and are using the same set of tools, so the analytics are coming out of the same software. So what you're looking at are reports again, that January to March period of time pre-COVID. You can see that Rent-A-Wreck store in urban Baltimore was down about 13% year over year. We weren't quite hitting the panic button, but we were beginning to ask questions about what was happening with the business. And looking at sources of business, this is a very different store. It's a very much focused on the bookings that happen at the counter and in our call center. You don't see the outside agencies booking a lot of business for the store in 2019. So they were, much the same in 2020 in the early part of the year. Then moving through March, again, completely separate company, but you see a very, very similar result to NextCar. In March, NextCar's business turned down 33%, Rent-A-Wreck's business turned down 27%. So we had a dramatic drop in the total rental agreements. We had a dramatic drop in the total revenue. And the sources of business, again, didn't change a whole lot because of that store's reliance on their own website, the call center, and its own store. And that just follows the demographics and booking patterns of the store itself. So hitting the worst of the COVID months here, the worst of the pandemic shutdown months, I should say, in the Baltimore area, you can see April, May, again, the exact same percentage difference, 66% year over year. You've got a $355,000 revenue for those 2 months combined in 19 versus 155 in 2020. So, very dramatic reduction there. 271 rental agreements against 832 the year before. And, as this was happening, the store became the real dominant source of booking. So, it was really the only people we were getting were the folks from the neighborhood who are literally walking up to the counter and getting into a car. And, it's the essential personnel, it's the nurses, it's the folks that need to get to work, that we're still working at, that we're still essential, like all of our employees. We were deemed essential, and we were very happy to not be shut down like many of the rest of the world was. So, and that was really our customer base. Go ahead there, John.
We've got a question here from Usman. How does the extension in average rental time impact your cost per rental and profitability? I'm not sure if that's directed to Jason or Mike.
Well, I would say generally the longer the rent, the more profitable, because a lot of your expense comes in the turning of the car, the check-in, the check-out. Mike, anything else on that?
Well, that's true, Jason. So the longer the rental, the less expense you have, because your labor costs technically go down because you're not handling the customer as much. So a longer length of rent generally means you have less expense, but generally it also means that you have less rate too. For example, when you get into weekly rates, there's some reduction in price over a daily rate, but it's less labor intensive. So in general, a longer length of rent is better for the business.
Thank you for the question. Any other questions, John?
Nope, that was it for now.
Okay, thank you. Next slide I wanted to look at is a slide charting that Rent-A-Wreck corporate store business in Baltimore, just the one store again, looking at the bounce back period now coming out of the shutdown June 1 through July 10. So you can see that this store was actually able to bounce back a little bit more than the NextCar stores did. It's now closed its gap between 2020 and 2019 to only 16% in terms of total revenue. But again, you can see there is a sizable gap in rental agreements. So that's telling us that we're getting, more for the average rental is higher. We're also able to, effectively sell extras, additional items like CDW and other coverages. So, and combined with this store's reduction in fleet, which will, I would say, ballpark about 20% less fleet that they're running in this period year over year. They should have about 20% less expenses now also. So I think that in the profitability look, this particular store will have returned to profitability in this period of time. Would you agree with that, Mike?
Yeah, in July, it's already showing, her July performance at that store is doing quite well. In fact, she's trying to add cars as of yesterday.
And when you look at the other corporate stores that you have, Mike, those 16 other stores, do you see a preponderance of them that are in the same boat, or is it falling back to that certain markets you're seeing bounce back and other markets you're seeing not bounce back?
Yeah, it's still market by market, Jason. Some markets have bounced back dramatically, and others are lagging behind, and you're not seeing as much action, and it's following the socioeconomic and education levels. So those people that are working from home and not going out of the house are still doing the same. They're working from home and not going out of the house. The people that have more blue collar jobs are, used to going out of the house, and they're out spending money. So it's still following that same trend right through the first 2 weeks of July.
Very interesting. And again, the sources of business, not a lot has changed there, although we do see a slight uptick in the GDS and outside source bookings. And we also see the website jumping back into 20% of the business there, with the majority of it being prepaid. So, again, a sign that the customers are having a little more confidence that they're taking that trip and are willing to prepay to get the discount. When we look at the big picture, the whole year so far compared to the year last year, for that one store in Baltimore for Rent-A-Wreck, we're down 31%. So in terms of revenue, this time last year, they were just over $1 million in revenue. Now we're at about 697 in revenue. So we've got a lot to make up for. But similarly to the conversation we had about NextCar, it's a little brighter, the outlook's a little brighter than it might look on paper because of the expenses reductions we were able to take, and the fact that we are continuing to see reservations rebound. Booking patterns continue to be strong in June and July. So looking at website bookings, so now turning our attention to our whole system, taking into account franchise locations in those far-flung markets around the country. You can see this is 2019, and I just want everyone to pay attention to the blue line, the blue chart. So this is what 19 looked like for the first 7 months of the year. And then this is 2020. So I think this is a very effective way to just visualize the pandemic and the shutdown. So, we had really decent booking months last year in March and April, and many of those bookings were for future pickups. So remember earlier in the presentation, I showed we had, 11,000 or 12,000 future pickups booked when we rolled into April last year. So we lost out on that booking period of time this year. This period was just completely decimated, and that's the sort of hole that we've had to continue to dig out of. And to put a little finer point on that, we had an unprecedented level of no-show and cancels through our reservations system in March, April, and May. We saw over a 90% no-show cancel rate at the airport. Local market stores hovered around 65 to 80%. People were locked down. There was, there were times when only essential personnel were allowed to travel. So it was really an unprecedented set of business conditions. OTA bookings from Expedia, Priceline, and Kayak reduced by 90% in March, April, and May. And to get to prepaids now, this is something that's easy to quantify. I think it puts a very fine focus on this. So these are the folks that prepay for their booking. They have confidence that they're going to go. They take the discount in exchange for a guaranteed reservation. Well, because of the extraordinary circumstances, we ended up letting most of those customers, all of those customers, cancel, and we ended up refunding those customers. So what we saw was we had $488,000 in prepaid reservations on March the 1st. Then by April the 15th, we had refunded all but $69,841 of our prepaid reservations. The following month, by May 15th, that $69,000 was down to $15,000. So we had gone from, in under 3 months, gone from just under $500,000 in committed prepaid business for franchisees and affiliates around the world, around the country, to just $15,000. So we were down 97% on our prepaids. So when I look at the 66%, our real physical stores were down. I'm glad they never got that far down. So, but the really bright side of that is in just 45 days, we've recouped 211,000 of the booked prepaid reservations. So we've had customers, going on our website, going through our app, booking reservations, and having the confidence to prepay for them, to the point that we've recouped back 45% of the 97% loss. So we're back to 211,193 from our high of 488,865 prior to the shutdown and the pandemic. So what's changed coming out of the pandemic? Well, the rebirth of the road trip. This has been very positive news for our industry. We've been customers of Kayak since 2004. We've had our inventory listed on their system. So that's 16 years. In that 16-year period of time, the order of the verticals on Kayak always went flight, hotel, car. Beginning somewhere around the beginning of June, cars became the #1 item listed on the Kayak service, along with road trips. And this is brand new for Kayak. So Kayak is now promoting road trips where you give them a geography like Cleveland, Ohio, and they allow you to set a driving time and pull up all these wonderful points of interest that you can do within that driving time of that piece of geography. So Kayak is pivoting to the road trip as the preferred mode of travel. The press is picking up on driving vacations as being the new normal. So this is a story that was in CNBC on June 25th. The road trip is back and it's better than ever. In Forbes, they're saying 2020 is the year of the road trip. This is in an article that published last week. In USA Today, AAA is predicting that summer travel is down, but not road trips. So after the lockdown, there is a desire to reconnect, and it's very strong. We've got people in this country that work in one city and have family that's hundreds and thousands of miles away that weren't able to be physically together. So we are seeing travel rebounding. It's not the same travel as we had before, but we are seeing customers come back to it. And now how are we adapting to those customers? Well, we've prioritized safety and cleaning of the rental vehicles, adapting the CDC guidelines for vehicle sanitation and instilling a culture of enhanced safety and cleanliness at our stores. We've installed protective coverings at our rental counters and other customer touch points, and we've distributed masks and other PPE to our frontline staff. We're also developing resources to go completely contactless with our rental process. We're investing heavily in our own apps that are available for download in the App Store for Apple and the Google Play Store, where the customer can download the NextCar, Priceless, or Rent-A-Wreck app, open a rental contract, provide all of their customer information ahead of time, fill out most of the rental agreement, if not all of the rental agreement, over their phone or their device before they even get to our rental counter. so that we're able to minimize our contact with the customer and create a more safe environment for our customers and our franchisees and employees. So much like the airlines have implemented contactless ticketing and have shifted the customer behavior over the years to be used to that sort of environment, we're also investing in developing those resources so that we too can facilitate that kind of transaction. And in addition to the apps that are downloadable by the customers, we also have an app that can be downloaded by our own franchisees and our corporate team members, and that's in the App Store as well. It's the MP Tools app that you see over toward the right-hand side of the screen. And this is also a tool we're developing to allow the staff at our stores and our franchisees around the country and around the world to get out from behind the counter and do a lot more of the transaction and work of the rental car store manager through their phones. So they're not quite as tied to doing business behind the counter. And you can see right in the middle, we have our car key there. That is for our phone as a key system, which we're not going to spend a lot of time on now, but that interacts with all three of these apps in a customer-facing environment as well. So we're very involved in pushing towards a future not far from now where the customer will be issued a key to the car through the phone and be able to access our vehicles without even having to take the keys from us at the rental counter. So these are some of the things we've been working on as we've dealt with the pandemic, and I hope what we presented earlier in this presentation shows, a quantifiable answer to that question, how's business? Because, from our perspective, it's been a hell of a roller coaster this year, and we went down to as low as I think I've ever seen us go, but we're also climbing out of it pretty fast, and it's an exciting time to be a part of the industry and a part of these companies. So we do have plenty of time for questions. I'm happy to take some, and you see all of our contact information here on the screen. If you have any questions about the materials we've presented, please feel free to follow up with us. And also, if you're interested in becoming a franchisee or an affiliate, please reach out to us and we'd be happy to speak. So, John, do we have any other questions from the group?
Not a question, but we do have a comment to echo what you said about how business is going with COVID-19. We have someone who has had a record month in June, record over 20 plus years, a record month in June. And to quote, "So very blessed, this mess has left us the most financially sound than we've ever been." So strange, but true.
That's great. That's wonderful to hear. So, Mike, how about any other feedback on the presentation or any other points you want to bring up from?
I wanted to bring up the used car market aspect of this. There was a lot of panic in the marketplace during COVID that the used car market was going to turn very, very bad. And that didn't turn out to happen. What ended up happening is a very robust used car market. So even those of us that our business is down 20 or 30 or 40%, we're able to sell the cars off at profitable numbers and adjust our business so we can continue. So again, that's what makes car rental better than a hotel. You can't lop off the top 6 floors of a hotel because you can't rent those rooms anymore. Whereas car rental in general, you have the opportunity to adjust your fleet size to the marketplace almost on demand. So we're blessed to be in this business. I thank everyone for attending. Good day. Oh, there's another comment. John?
The comment is that one of our partners in Canada is doing very strong in pre-owned cars.
Okay.
Yeah, and that's part of our model as well. One thing that perhaps differentiates us from some of our competition is that all three of our brands are focused on the pre-owned business, from Rent-A-Wreck to Priceless to NextCar. And I think that gives us tremendous, and our franchisees and partners, tremendous flexibility. And the used car market, we know, has been very hot.
We have another question from Usman. Do you guys have any visibility on July, August at this point? Are they shaping up better or worse?
Better. They're shaping up very well for us. We've got a very strong pre-booked book of business for July and August, and we are not seeing cancellations yet. Knock on wood. Obviously we've got big markets, big locations in markets like Orlando and Miami. So we watch the news too, and we see that there's concern down there. But I also see that Disney opened this week, and it sounds like it went pretty smoothly. And from where I sit looking at our res system every day and monitoring our no-show cancel rate, no, we're seeing normal no-show cancels. We're seeing strong bookings for future pickups. So it looks like the traveling public in the United States, at least where I'm the most plugged in, is moving again. They're taking these trips, they're renting the cars.
The waits at Disney World in Florida. So I was listening to the radio on the way home a couple nights ago. What normally is a 2-hour wait is 5 minutes for each ride. So you could do Disney World in 2 days.
You might actually convince me to do it then.
But you have to wear a mask.
I'll blend in with Mickey and the rest of them.
It'll be interesting to see Mickey in a mask.
Right.
We have another question from Jason. Can you speak to lending? I'm finding it hard to get loans as a new company. We started in January 2020.
Yeah, not unexpected. Mike, do you have any insight in that?
Yeah, so, all the lenders pulled back from the marketplace because of COVID. There were a lot of stressed companies. So a lot of lenders maybe got hurt, maybe didn't. There was a lot of leasing companies that had to take back a lot of cars. So there's a lot of stress in the marketplace right now. But I think that you just need to be patient, and the marketplace will come back as soon as everybody realizes the strength of the used car market, because I don't think that's common knowledge everywhere just yet. It's a couple, 3 or 4 months away. So the lending will come back. You just need to be patient.
And
Thank you, Mike.
Go ahead.
Jason, you have some comments on that?
Just that if Jason had any questions, or if there's anything we could do to help, please reach out.
So we have another question from Ahmed. How are you dealing with vehicle shortage and prices going up at the auctions?
That's you, Mike.
Well, yeah, so you have to raise your prices to match. So you're going to have to get more revenue out of the cars that you're renting. You're going to have to incur more depreciation. You're going to have to get a higher daily rental rate. That's what's going to happen from this point forward. In fact, I just read an article this morning. General Motors quit making the Chevy Impala this week. So now there's another car that's gone. So soon there won't be any cars left. There will only be SUVs, and that's going to raise everyone's operating costs dramatically as cars as we know them disappear from the marketplace. So there are fewer and fewer cars left, and SUVs is going to be all that we're going to have to choose from. So it's all going to come back to getting more price. So the cost of everything is going to go up. That's going to be a lingering effect of COVID, I think, across the board. Not just for our business, but everywhere.
And to echo Mike on getting more price, we've seen that rates have held strong in most markets. And at our stores, we've seen customers keep the vehicles longer. So we're getting more margin on the business that we're getting now. So getting more rate doesn't necessarily mean raising your rates right now. Obviously, you have to stay competitive, but the customers are keeping the vehicles longer. And of course, you can put an emphasis on upgrades and additional driver and prepaid gas. So there's lots of ways to increase your DDA. We do have another question. What is the sentiment, not the sentiment, what is the thoughts on this Hertz bankruptcy? Are we thinking it's going to hurt car rental, help car rental? Too early to tell? Is this an opportunity? What are your thoughts?
So I've lived through the Budget bankruptcy. I was a Budget franchisee when Budget went through bankruptcy. So here's what happened from the inside back in 2003 when Budget filed bankruptcy. Lots of my good friends called me the day after Budget filed bankruptcy and asked me, am I going to be okay? And I told them, sure. Doesn't have really had any impact on me. And then after that, I never heard another person, customer or friend, ever ask me about Budget's bankruptcy again. So what that little story means is that now that Hertz has been declared their bankruptcy, it's over. You're never going to hear about it again. It doesn't make any difference to the customers. It doesn't make any difference to the providers. Everybody has been secured in ways that they're satisfied, or they stop doing business with Hertz, and it's all going to work out in the long run, and you won't ever hear about it again. So it does create opportunity. There will be areas of business that Hertz will not be able to pay attention to, and that should be opening up doors for all of us. So you should be looking for opportunities. Enterprise is probably a little stressed right now too. They have not opened all of their stores back up in our marketplace, so I assume that has occurred in other cities also. So there could be opportunities on the horizon. You need to open your eyes and start looking for them. Just depends. Go ahead, John.
That's it from the panelists, from the attendees. All questions have been asked and answered.
All right, well, I see we're just about out of time. I wanted to just take an opportunity to thank everyone that joined us today, and thank Mike Delorenzo and John Dill for participating and helping out with the webinar. We are hoping to continue to do these webinars, and we'll continue to promote them and let the folks that attended know when they're coming, so we can keep you apprised of our progress as we all work through this new reality together. But it's been a great last couple of months as we start to climb out of it, and I'm happy to share some of the what we are cautiously optimistic, and some of our optimism that we've started to turn the corner and show strong signs of progress and a return to growth. So, Mike, anything further?
No, thank you all for attending. Good day.
Thanks, everybody.